This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, MICHAEL COVEL. Not filtered, raw, honest. That's my passion. My guest today is Jack Schwager. If you've not read Jack's works, if you've not read The Market Wizards, for example, you clearly don't want to know about markets, trading, and investing. That's where you start. That's the first book. Literally. But don't let me beat you up too much if you've not read Actually, you know what? I'm going to beat you up. If you've not read Jack's works, if you've not seen his books, give up. It's over. You're done. Today, we dig into one of Jack's classics, rebooted and updated. And if you want to know about the futures markets, this 700-page plus Jack Schwager work is worth your time. I'm always indebted to Jack because he was the first guest that really helped to propel this podcast to millions and millions of listens. I hope you enjoy this next conversation with Jack Schwager. I have to say, Jack, you're quite prolific. I'm now holding in my hands, let me count the pages here, 704 pages. Nobody is going to compete with you on a reference guide for the futures market. I think you have scared everyone away.
Well, thanks. Like I try to do my best, basically, and this book, this book really goes back all the way to '84, the origins of it. So this time, the work I really did was a sabbatical I took in '80. The book came out in '84. The sabbatical I took was in '83 to write it.
Yeah, but you've been constantly updating, I assume, too.
Yeah,
yes.
yeah. Well, I had. That's why I got Mark Etzko. I don't know if you know Mark.
He's quite good.
Yeah, he's excellent. So he's the only person I trusted to work on the update. But, Wiley wanted me to do the update. So look, if Mark was willing to do it, I'll do it. Otherwise, I'm not interested.
Yeah, it's a lot of work. Really, it's one of those things where I look at it and I say, even with some of my books, I could have taken this level of granularity that you guys did. It's amazing. Really, it's a lot of work. I would, as a big picture, and we're talking about a complete guide to the futures market. Second edition, Jack Schwager, Mark Etzko. This is a reference guide in the sense that you guys are not attempting to say to the audience, everything in here we think is how it is, but what you are giving people is, here is everything, and now here's some views from us, but it's not like a polemic or anything. It's very like, here's all the facts, and you're kind of leaving the audience a little bit with, you're going to have to make some choices on your end too.
Well, I am opinionated in it, as you might have noticed in certain sections. My intent is to I guess the key difference here, from my own perspective, versus like I see a lot, not that I've read a lot of books, but anything I've read a lot of times, is people will give you the stuff and say, well, here it is, and they give you a nice example, and it looks great, and everything you think, all you have to do is just follow that, and life will be great, and there'll be a money machine from there on. It's like an unbelievably and an unrealistically rosy picture. So what I try to do instead is I go over all the aspects, all the tools, but I also keep very opinionated in saying what works and what doesn't work, and also even stuff that works, as you well know, I fully appreciate, as a professional, if things work a little bit better than 50-50 and you got some discipline, that's great. Realistically, it's only the novices and the charlatans that have these 90% make $1 million a year, easy money type of pitches. So things that work with a little bit of an edge, but you have to respect that they don't work all the time. And the real important stuff in the book, I think, is not so much telling people here are all the stuff that can be used, but also giving them hopefully a realistic perspective of here's where it doesn't work, and when it doesn't work, this is what you need to do, that type of thing.
I've got a starting point where I want to begin today, but before I get to there, based on something you just said, I want to kind of dig into that a little bit. if you or I were to go on to Twitter any day of the week, perhaps even some notable names to some degree, but mostly just, I would say, average people. And, of course, there's the huckster spectrum out there. But the idea is that, it's easy to make 5% a month. And this mentality that somehow or another, like even if you do some basic math compounding, I mean, if you were making 5% a month, I mean, you're now right off you're better than Warren Buffett could ever imagine to be. We've really got some, I'm still amazed at this day and age, there are so many people out there that will peddle. And frankly, there's a lot of novices and beginners. I guess they just want to believe so bad. But I mean, my gosh, if you're being promised something that far would exceed what Warren Buffett has achieved in a lifetime, I mean, it's probably time to hit the pause button, isn't it?
Yeah, absolutely. I mean, that's, you have on one end, of course, you have people who are just pure charlatans and frauds and all that. And God knows there's plenty of them out there. Then you have people who are not in that same class. They may be legitimate, but they present stuff in a much better light without any caveats than it deserves to be presented, with a misleading impression. In fact, I don't know if you saw that one section I had, one section of the book I call The Well-Chosen Example. And this was something that stuck with me. This is something that occurred to me very early in my career. And it stuck with me all these years. At the time, just to set the scene here, I was working with a physicist named Norm Strom, who worked with me on developing trading systems. And Norm, I've lost touch with him. I haven't spoken to him for a couple of decades, but Norm was one of these brilliant guys, just, a Merit Scholar winner, PhD from MIT, wherever he went, just one of these people made me feel dumb. But anyway, I was working with him and we were developing systems and everything. And then one day I read this article and showed this example of it. I think it was in what was used to be called futures. I think back it was called futures. It was called commodities back then. I don't remember. It looked like a really, it looked like a very, simple system, and yet the results were so great. And when I broke the system down, it really was only consisted of two parts. Now, one part was sort of a medium term, and this is right up your alley here. One part was like a medium crossover moving average, like trend following. And I said, well, I've tested that, it doesn't do anything like that. And the other one was also a crossover moving average, was very, very short term. And I said to myself, gee, I thought that really wouldn't hardly work at all. I don't think I even tested parameters that short. I thought, am I missing something? Could something this simple really be that good? So I had Norm, I asked Norm to run the result, run the system. And it turned out, so the example had been a Swiss franc. And the Swiss franc in that particular year, the example made $17,000 a contract. Really, really good. Well, we ran the system on like a whole portfolio of markets, and for like 10 years. Well, of course, out of all the markets and all the years, of course, no surprise, the Swiss franc in that year was by far the best. But the thing was, the system actually, once you put in transaction costs, lost money in most of the markets. It lost more than it made, and even in the Swiss franc, it barely made any money, and that was only because it made a little bit, but because it had one great year. So the system itself was actually a losing system. But if you read the article, say, wow, this is really good, and you go and follow it, and you lose money. Now, at least the author there wasn't wasn't a fraud or anything. He just wrote the article. But there are people who take stuff like that and then sell it to you for $999, show these great results, and unfortunately, people fall for it.
If there's no diversification, if you're not trading a basket, I mean, for example, if we were talking something like a trend trading system, a trend following system, you can't do it on one market alone. I get emails all the time. People, they want to apply a system to one market alone, and they seem to have not yet grasped the idea of diversification, because you can't bet can't bet the ranch on one market. If you're doing that, then you might as well just kind of become a buy and holder of the S&P and be done with it.
Well, I mean, I totally agree with you on the diversification aspect. Here I was just taking the cherry-picking aspect of it. But even if you had a system that seemed to work well in one market, still, as you say, very risky, because the past is not the future. If any system's any good, it should work on a portfolio, not just one market. If it works on one market, you can pretty much assume that you've overfitted the darn thing, and you're just you're fooling yourself. So I totally agree. Diversification is one of those things that you can do that is free and it can only help results. I'm totally with you on that trying to find a system for one market is usually not a very wise approach to begin with.
Let me take you back in time. I don't think I've asked this question or talked about this on a prior episode with you. And I actually went back and through the magic of Google Books, and I noticed this particular name in a lot of your books, and you reaching out and thanking him. And I'm going to shoot myself if I talked about this before, but I don't think I have. You cite Stephen Kronowitz as a mentor. And I would love for you to go back in time and set the stage as a young guy. I believe you're right out of grad school and you're kind of about the early to mid 80s. And you meet Stephen. Set for the audience, you as a young guy, before you've sold all these millions of books, you as a young guy, you've got a certain view of the markets. I would love for you to describe what that is. And then I would love for you to describe meeting Stephen and what happened.
To give it a little more background, so my background, I'm a master's in economics from an Ivy League school. Basically, coming from that type of background, pretty skeptical of technical analysis, not because I had ever examined it, but just sounded like, it just didn't make any analytical sense to me, right? And I'd pretty quickly in the business worked my way up to be a director of futures research. I was an analyst for 2 years and then wrote some stuff and got promoted I got another job for another firm, the director of futures research. So this was that firm a couple of years in, and I had a number of analysts working for me, and Steve was one of them. Steve was the only technical analyst, and the other guys were all fundamental analysts, as I was. And I noticed that Steve was the only one who was basically more right than wrong, I like to think I'm an open-minded guy. And Steve and I worked in the same room, and Steve had a great sense of humor, and we used to just kid all day. We got along great. He was a terrific friend. Finally said to him, Steve, okay, you got my interest. Tell me what you do, and explain to me. And so he was the one I learned technical analysis from. And like my books, like this book, it's like loaded with technical analysis. And I got to tell you, I didn't get technical analysis from any books. I got it from, what I learned from Steve and then just watching the markets and what I picked up here and there. But I didn't actually do research to pick up those ideas. I mean, he's really the genesis of my exposure, my knowledge in technical analysis. And I found once I started speaking to him and understanding what it was, I got that the reason it works more often than it doesn't work, it works with some sort of an edge, is that it's a reflection of everything that's going on in the market. So it's not that there's anything magical about the charts. It's just nobody can operate in the markets without it being reflected in the charts. Like you throw a stone in the water, it's going to make ripples, right? So it makes sense that the charts would reflect what's going on in the markets in some way. Doesn't guarantee that they could be used profitably, but at least it's not magic. There is a logical explanation of why it can work. And the other critical thing, this was absolutely essential, that I got was that where fundamental analysis, you're faced with this dilemma that it is contradictory to good money management in its very essence. By that I mean, let's say you do fundamental analysis on a market, and I decide, let's say the market's wheat, and I decide wheat's a really strong buy at $6. Well, if I go long and it goes to $5.50 and nothing has changed fundamentally, logically, based on the same analysis, what should I think? It's an even better buy. The trouble is, the worse the market goes against you, the better the trade seems on your methodology. It is really, really tough to combine money management with fundamental analysis. They almost work in opposite directions. But as you well know, if you're on a technical side, if the market goes against you, in most technical approaches and most risk management, you'll have a way of getting out that's consistent with the methodology. And so I discovered that by using technical analysis instead of fundamental analysis, I could place trades and have my risk management, my stops in, and it was part of the methodology. And that I found for myself worked way better. So he was kind of essential in sort of converting me from a fundamentalist to a technician, even though I was very, very skeptical.
Jack, in the statement you just gave, though, I think people should replay and listen to what you just said about the risk management attached to fundamental analysis. But I detect you're not very harsh as you say it. You're being fairly diplomatic, but in reality, how does risk management really work with a true fundamental perspective? Given the example you just mentioned, I mean, like you said, if it goes down, it even further buttresses the theory you had to begin with.
Yeah, it's very, very difficult. But in my career, because I've interviewed all these great traders, and some of them were indeed purely fundamentalists. Now, I can give you one example to sort of explain it, but it requires, well, okay, let me just give you the example. So I'll use Joel Greenblatt, not Joel Greenblatt, I'm sorry, although he's also a fundamental argument, but let me use Martin Taylor instead. Martin Taylor may not be a familiar name, at least for people who haven't read my book, even though he managed a lot of money, and he was originally an emerging market manager, the best emerging market trader that I was able to uncover in my career. And I interviewed him when he actually, back in 2012, he was managing close to $7 billion at the time, both in long only and long short. And he was in the process he had notified his traders that he's closing all his funds. Interestingly, this decision came at a time where he was close to he wasn't that far off his all-time high in NAV. So it wasn't that he had bad performance. He just didn't want to bother with investors trying to influence his trading, and he didn't want to have to manage the traders. And particularly because he was a fundamentally oriented trader. He's very concentrated. He'd have his small number of stocks, under 20, maybe 15 or less sometimes, that were most of the position. And he was very confident in those positions. And he did not have stops. He didn't believe in stops. His risk control was not letting any position be too large, and also just being extremely good and knowledgeable. I'll give you a perfect example, but this requires an enormous amount of skill and confidence to pull off, and he pulled it off over his entire career. But here's an example that I've used. I don't know if I've used it before when we talked, but it's still a good example. I interviewed him at the time when Apple, before it split, it had gone from 500 down to 350. That's the scene when I was interviewing him. He was emerging markets mostly, but he also had developed over the years also following developed market stocks, and he had one big loss in his portfolio, which was responsible for his entire drawdown, which was for him fairly high at that time, it was about 15%. That stock was Apple, and yet when I spoke to him, the position he was most bullish about, and this goes right to the heart of what you were asking, was Apple. And this is the way he explained it. He said he's looked at all the analysts' forecasts. He sees what they're forecasting for 2013, 14, 15. All these guys are doing, he said, with a bit of contempt, is just extrapolating the returns, the earnings from past years, assuming it's going to be the same pace in coming years. He said what they're all not putting into the equation is that Apple sales are going to explode in China and the rest of the rest of the foreign sales, and it's not in the numbers. And so to him, Apple was even though it had gone against him, it was a wildly bullish trade. Within a half year, when I spoke to him, the stock had doubled. But that's just an example how it can work. But there are very, very few people who were as good as fundamentals as Martin Taylor, and so there are people who can do it. But for most people, risk management with fundamentals is difficult to pull off.
Yeah, it's limited capital is the crux of the matter there. Hey, let me go back really quick to Stephen. You kind of got me thinking there as we were talking about him. He's your introduction to technical analysis. Did you guys chat? How did he get into it? I'm always fascinated by this thread that goes along with the learning of technicals. Because there was, and also to ask about that. But once you got that exposure from him, did you start to backfill and then find out about other people that had come, like a Richard Donchian and stuff like that? How did that go for you?
Not at that time, Mike. That really came later, and it wasn't, of course, Donchian. It came later when I did the first Market Wizards book, which was 5 years after I had done this complete guide, the first edition, which was 33 years ago. And it wasn't until I started doing the Market Wizard books that I started talking to people like Sakota and other people who were purely technical. Tell you the truth, I don't think it wasn't a matter of technique there. It was really more a matter of trading philosophy and experience and all that. It wasn't so much the nuts and bolts of technical analysis that was kind of stuff like I had conversations with Steve and just through my own experience. And that's the kind of stuff that I have in the complete guidebook. But I didn't have input from other traders, and I never sought any, like I say, if I had any mentor, it was Steve. I didn't seek anybody else. Once I kind of had the basics, I just relied on my own experience for how to utilize it.
Speaking of the basics, I think it'd be interesting. I hope maybe a little boring for you, but I think it'd be interesting for the audience because the idea of trading futures for still a significant majority of the population is like, okay, that's past my pay grade. No, thank you. But the idea of futures trading, and I had to go quickly back through Wikipedia just to kind of get my brain recharged. Mesopotamia, 1750 BC, Aristotle writing about olives and olive presses and timing it there. The first futures exchange, Japan, the rice market, and then London, or roughly the same time, London. The U.S. didn't come. I mean, a lot of people think the U.S. was the start, but actually we didn't come till after a lot of this. Why don't you, for the audience, paint a general picture of the futures contract and the use, talk some hedging, talk some speculation, give people a decent professorial view on the subject.
Okay, so let me answer it sort of perspective. Your audience is going to consist of people who know what futures are, and people who don't or don't really have a good grasp of it. So I think the people who know, there's nothing I can tell that's if to answer that question that's going to be terribly helpful. So let me answer for those who are kind of haven't traded futures. Maybe they think they know a little bit about, but don't know a lot, whatever. So here are the key essence of futures markets. First of all, and in no particular order. First, futures are very, very liquid. So very easy to get in and out. That's number one. Number two is they trade for just every type of instrument you can think of. There are futures for commodities, such as metals, let's say, gold, silver, platinum, copper, etc. There are futures for grains, all sorts of grains, corn, wheat, soybean meal, etc. Those are more and then of other agricultural markets like sugar and cotton, etc. And then that was actually most of the markets, which were then called predominantly commodities, up to about the beginning of the 70s when they started introducing financial futures. And then over the course of the 70s and then into the 80s, financial futures became an ever-growing sector. Now I think they're probably 2/3 of the pie. But the three major segments of financial futures were currencies, were and are currencies, interest rates, and stock indexes. There's a whole range of developed countries' currencies you can trade. There are all sorts of interest rates you can trade, both domestically and foreign. And there are all sorts of stock indexes you can trade on futures. And the other thing about futures is it's easy. It's as easy to go long as to go short as it is to go long. In fact, there cannot be a long until there is a short to match it. So it's very easy. You want to go short, you can go short. So there's no bias to picking the long side. Any market you have an opinion on, if you think stocks are going down, the easiest way to make that bet is pick the stock index you think is most vulnerable to a decline and go short that contract. That is the easiest way to express that opinion. So any market in the world you can think of, any major market, whether it's commodity type or financial, you can find a futures market that reflects that price. And it's as easy to go in, buy or sell. The word futures, for those who are wondering what is this futures about, is that, and this leads to another key element of what futures are, is that they're all the same. They're all, you don't have to find, let's take a specific example. I'm a farmer. My corn crop is coming in October. The price is good now. I want to lock it in. The price, let's say it's going to come in October, November, in December, I'm going to be ready. I want to market my crop. The December price is very attractive, but I'm afraid the price is going to come down before then. Futures allow me to sell December corn, which will require a specific grade of corn for a specific date. It doesn't make a difference if my grade's different or my date of delivery is going to be a little different, because it's going to be close to what that price is. They're going to move in tandem. So if I sell December corn futures for the quantity that I am expecting to harvest, actually not the total amount, because I may not have the total amount. I may have some crop failure or whatever. But if whatever amount I want to insure, then I can lock in the price now. On the other hand, there's some speculator who may think corn prices is going up, or there might be a mill that needs corn and is willing to buy the price that it's trading on in December, and they'll be on the buy side. And in both cases, in most cases, it never goes to delivery. Both parties, both on the buy and the sell side, are just using it to hedge their price for that period of time, and whatever grade they have of that commodity, or it's going to move pretty close in tandem, and they know what the normal price spread is, so they can use it in that way. The fact that it's one contract that's precise is why it works. If you have an item that doesn't lend itself to uniformity is very, very critical for a successful futures market. I remember way back in the 70s, somebody tried, and I think it was in California, probably only California can come up with this. They tried doing a diamond futures, and probably, I doubt very, very many people in your audience even have heard of this or know about it. And I just remember it. I don't remember reading about it. So they came up with diamond futures, and the market opened. And what happened on the first day? It went limit down. What happened on the second day? It went limit down. What happened for every day it was open? It went limit down. The market went limit down every day until they killed the market. The reason was because diamonds have so much variability. The contract was written in such a the contract specifications were broad enough so people could deliver all sorts of diamonds that were worth less against the contract. So it basically killed the market. So you need something that has great uniformity. So something like diamonds wouldn't work well. Something that's highly perishable won't work well either.
Let me give you something to add to that and let you expand on. So many people will hear the phrase speculation, and you always think all the speculators, they all get rich, they all win. Well, I want you to expand on this, but speculators do not all win in the futures markets. Plenty of them go bust. That's one issue. The second issue with futures markets compared to, a futures contract is a derivative, but unlike these kind of off-exchange, bank-created derivatives, perhaps at the Great Recession time period, very different than futures contracts. Futures contracts, as long as you don't have some bad operators, and there have been occasional bad operators, but futures contracts are something that you can believe in. And as you've just kind of said, the hedging and the speculation balances out. It's a zero-sum game. Why don't you comment on the idea of speculation, not all speculators win, and the idea of comparing to some of these derivatives like credit default swaps, some of these things that are, kind of arcane, created by banks that really can set us up for trouble. That's not a futures contract.
No. And all these other derivative products that you talk about, first of all, they're going to be a lot less liquid in almost all cases. They're going to be, considerably less liquid. You're much wider bid-ask spread. When there's a panic, and like in 2008, most holders of some stuff like credit default swaps may be on the same side, and they can't all squeeze through the door at the same time, and then you really got problems. A lot of the derivatives that are out there may have large spreads, and they may be a lot less liquid, especially in crisis times, which is different from futures. Futures are always, it's possible for an event to come out and futures to get lock limit or something like that does happen, but there's a clear reason for that. But by and large, normally you can just get in and out of futures much more easily. Now, on a question of speculation, speculators don't always win any more than people who make their own trading decisions in the stock market win. It really depends on the skill of the person. What I love is something like when you get something like an oil prices going up, like when it went to 145 or whatever it was a few years ago, you get all the press with speculators driving up the oil prices. Speculators are driving up the oil prices. I'm still waiting and if anybody has seen one, please let me see it. I'm still waiting to see the first newspaper article, speculators driving down the price of oil. I'm still waiting to see that.
But that's such an important point, because you mentioned at the beginning of this conversation, you can go short or long, doesn't make a difference, just as easy. And that's so critical, because, when you see that oil price on reverse, and it's at 40 or something, well, speculators are responsible for that too, right?
That's right. Yeah. So, that's the thing. It is a zero. Futures are truly a zero-sum game. And by definition, that does mean that more money will be lost than is won, because everybody has a bid-ask spread to cover, except for the people making a market, and there's some sort of commission cost, right? So given that, by definition, it's that part of it is almost like like a casino where more money will be lost than won. The big difference is a casino is impossible to beat unless you're Thorpe and you do it in some way like Newtonian physics on a roulette wheel. But in a normal sense, in normal betting, it's impossible to win. Whereas the futures are real markets, they're real fundamentals. If the Fed changes course and keeps on a different course for a few years, there's a real reason behind that trend. The prices are just not going up and down randomly. Yes, there's a lot of random motion in there, but still basic trends have some sort of rationale and reason behind them. So there is a reason why you could win if you're skilled in futures. There's no reason why in fact, it's impossible to win in a game which has a less than 50-50 payout, which are all the casino games. So futures do have a less than zero payout because of the bid-ask spread and commissions. However, the skilled players can beat the unskilled players. I guess a good example would be poker, where there isn't, let's say, a casino taking out a lot of money out of the pot. But if a bunch of poker players get together, even though there's a lot of luck involved, and even if there's some money coming out, let's say the casino does take some money out, you could still make a rationale why a good player could win, because that good player is just going to be better at assessing probabilities or bluffing or whatever. They're going to have better skill. So there is a reason, unlike other games, a chance.
As you mentioned Ed Thorpe, I was going to toss this out to you, and I'll remind you when it comes out, but I actually have someone coming on my podcast in the not too distant future who's doing the first biography on Claude Shannon.
Wow.
Yeah. Really should be interesting.
Because they work together on that. In fact, they worked together specifically on that project to beat the casinos at roulette. So you had these two great minds working on this problem.
There's a Claude Shannon YouTube video you should watch. I'll send you the link if you haven't seen it.
Oh, sure.
He's got this electronic mouse learning as it goes through a maze, and he did this like in the 50s, and you're just watching it going, hold on, he did this 50 years before anybody was doing anything. Just so brilliant,
Yeah. I'd be interested in seeing it.
Hey, listen, let me jump into something that I think gets right to the heart of the matter, or one of the hearts of the matter in your work here. A trend. When people come at me all the time and they talk about saying, define the trend. It's not so easy, is it?
Well, yeah, actually a trend is what most people think it is. It doesn't mean it's easy to trade. It's a predominant movement of a market in one direction. It's as simple as that. But, but Sakota has a great line. I love Sakota's, he has this great way of saying witty things with a lot of meaning in very few words. The one I'm referring to here regarding trends is a trend is your friend until the end and it bends. Sure, you can see the trend in the past. You just don't know how long it's going to continue. And in fact, people who profit from trends are not always the ones who wait a long time to see it. They could be people who anticipate a reason for the market to trend. In fact, that's a way where fundamentals can be combined with technicals in a way.
Well, that's where I was really going, because as you lay out in this work and you talk about technical analysis, it really brings up, as we're talking about trend, the idea of either predicting a trend on one side of the equation, forecasting it, or reacting to the movement of a trend and getting in kind of late. It is two different ways of thinking, isn't it?
Yeah, they're two different approaches, and ironically, they can both work, or they can both not work, but they can both work. So you're more than obviously you've written a lot on and done a lot of work on with trends being defined and trying to make money out of the continuation of that trend, and that's sort of the second way you referred to. Well, the first way might be, for example, let's say you see. Let me go back. Let me use this example, and it's not a trend. Well, it's about a trend, but it's not a trend following example. Stanley Druckenmiller, who I interviewed, I guess, in the New Market Wizards, was telling me the story. He worked with Soros, so he's telling me this story about Soros when the Plaza Accord in 1984, where the currencies had this long trend one way, and then there was this accord, and it completely reversed. In that particular situation, Soros was long the yen, and his traders were basically, coattailing him. They were long the yen. And then there was the accord, and the yen went up like 700 points overnight, some huge amount. He heard his traders selling, and he comes running out of the office. He says, stop. anybody who doesn't want the yen, I'll take all your yen. And and Druckenmiller said, Soros's line was, the Fed is just, the central banks have just told me that the yen's going to go up for the next year or two. Why do I want to sell on the first day? So there's an example of somebody who sees the fundamental reason for the trend. Now, the way, and I say you can combine that with technical is, well, that could be a reason. First of all, you also would have a technical movement. You'd have a big gap. You'd have that. But even if you're just based on the fundamental reason, then you can use technicals to sort of follow it, maybe use technical to protect yourself, to define where you get out, So it could be, you can combine it in that way. But it doesn't mean that you have to wait for a long time to actually define the trend. You can, under certain circumstances, define it early if there's a reason to expect it, or there could be a one-day type of move that looks definitive, and you're willing to go with it. Or even better than that, and I think I talk about this in the chapter. This actually is in the fundamental section. One of my main points about fundamentals is they're most useful in a contrarian way. It's not so much that fundamentals are great and to tell you exactly what the price should be, but what's really neat is if you have something comes out fundamentally that should move the market one way and it doesn't have much impact, that's actually telling you a lot. You can have a market, let's say something comes out that's very bearish and you think it's going to go down a lot, and market goes down, then pops right back up and closes strong. You can look at that and say, oh, wow, and this fundamental news, it should have gone down, it's closing up. Something's wrong here, it's going up. You can go long then, and you can use technicals to follow the market to to find a point where the market breaks down and where your stop is going to be to get out. So there's another example of just the very first day being able to make a decision based on fundamentals and then still combining it with technicals for risk management.
Jack, I remember back in the day seeing the notes that Rich Dennis gave his students for the first time, and there was some chart pattern type stuff in there, and you cover classic charting quite a bit in this work. Is there anything today in terms of the idea of classic charting that can mean a lot of things to a lot of people, and you cover it in depth? Is there anything that cannot be coded? Can anything that one would describe as classical charting be made automated?
Yes and no. Okay, so
I like to catch you on those kinds of answers.
Yeah. So let's say certain things, of course, can be exactly defined, right? It's breakout. You can define that pretty simply and straightforward. But let's say something like a head and shoulders. Okay, a head and shoulders is one of these patterns that's somewhat in the eye of the beholder. Now you could specify a whole bunch of things that to you make a head and shoulders, but you could change those rules slightly and it would still be a head and shoulders and somebody else's definition of head and shoulders. So the answer is yes, you can. For certain patterns, you can always you can always code something that will provide you with a reasonable facsimile of a head and shoulders pattern, but it may not encompass all head and shoulders patterns, and it may encompass some that are maybe dubious, or some other people would say shouldn't have been included. But there's no absolute one way that you can define a head and shoulders mathematically that would satisfy everybody, because there's always some variations or combinations that may make a difference. So yes, you can define patterns that meet certain conditions and test them, but it would be that particular definition of a pattern. Now that's only one dimension of the problem. Maybe the bigger dimension of the problem is when you look at a chart, it's not clean and simple like, boom, here's a head and shoulders and there's nothing else on the chart. There's usually lots of other stuff on the chart. Maybe there's a top pattern or a bottom pattern of another type, or consolidations of another type, or breakouts, or on and on and on. So any charts can have a lot of different elements, and who's saying what time zone? Maybe you're looking at 6 months. What about the 1 year chart? What about the 5 year? What about the 10 year, right? So there's all different time dimensions to look at it. So when you get right down to it, there are going to be multiple patterns on multiple time frames. It becomes more in that sense an art than a science. And this is one reason why I think it's possible for the individual still to come out ahead, even though computing has gotten so incredibly advanced, both in its power and scope and artificial intelligence, all these things, because there's so many patterns that can exist that the computer can't test all of them. The combination of experience and a multitude of patterns can make some people profitable traders in a way that is not going to be duplicated by any quantitative system, if that makes sense.
Yeah, and I think this opens up a bigger can of worms, and people are going to have to dig into your work to see this even wider. It's very detailed. But it brings it back to philosophy, because I'm sitting here and I'm making notes as you're talking. It's like, okay, if we're going to choose a certain trading philosophy, we can imagine, okay, can we automate? Can we code this process? Can we not code this process? So then you have science versus art. But then when you bring it down to the day-to-day, if you choose the science direction and you code it, that kind of changes your day-to-day life, so to speak. It's a choice. But if you can't code it, that also presents a different choice where I would think the natural conclusion would be that if you're going to go down the art side of the equation, you're going to be a little more involved with screen time. You're going to spend more time in front of the screen because it is going to require that kind of instinctive, intuitive approach, that experience approach, versus if I go the science side and I code it all up and it's ready, set, go, and I don't even need to look at a screen during the day. Would that be a fair assessment?
Well, that's right. I mean, if you do code if you computerize everything, it does take of course, a lot of work to do that. But once that's done, and it's assuming you test it properly, and proper testing, we can talk about that if you want to go for that tangent later. That's critical. But assuming that you have tested it properly and it seems to work, then sure, that's a easier approach once it's in place, because then the computer basically signals the trades, and you can even computerize to the point where the trades are automatically entered, and then that's it. So that after that point it's automatic, and that's easier. But it's also a question of what you're comfortable doing. Now, I've been on both sides of the fence. In one time of my career, I actually said, hey, I just want to have everything computerized. I don't want to have the emotionality of having to make decisions. And that was a period of time where I was working more with trading systems, and even with a partner, Louis Lukac, we were managing trading systems and stuff like that. So that was one period of time. But ultimately, I found that my personality, and this is where personality comes into, I think you have to know where you are and what you're comfortable with. To be a good trend follower, and again, you've written about this, you've spoken about this, you know this, you have to be willing to stay consistent, to follow the system, to live with the drawdowns that are inherent in the system. The system can't work. If you try to eliminate the drawdowns, you'll get stopped out of even the good trades. So to get the good trades, you have to be willing to accept a certain amount of drawdown. Now, I found myself uncomfortable just not having control and having to just wait until everything turned around, and that just was not comfortable for me. And so ultimately, I decided that, hey, what I'm more comfortable doing is picking a trade, putting a stop in. When I put the trade in, I know exactly what my risk is. That I can sleep with much better. That turned out to be an answer for me. But that is where what's right for one person is not right for the other. So I think people have to decide, hey, is a computerized approach my personality, or am I more of a hands-on type of personality? And by the way, that doesn't mean you have to sit in the screen in front of the screen all day. In fact, most good traders that I've met who are technical don't suggest it. In fact, they have the opposite advice, that it's really a bad idea to watch the markets too closely. Like, again, quoting Sakota. When I asked him, Sakota didn't have a quote machine when I interviewed him. I'm in his, I spent the day with him, and I look around and I said, Dad, what about the quote machine? He said, well, I don't use a quote machine. I said, well, why not? He said, well, it's like having a quote machine on your desk is like having a slot machine on your desk. You just end up feeding it quarters all day. That's a good point. You just get tempted to make trades on meaningless movements. And a lot of good traders really don't do anything other than at the end of the day, and sometimes even just at the end of the week. So they'll do intensive chart analysis if they're using charts, let's say, and they'll do that at the end of the day, or like I say, sometimes even just at the end of the week, make all the decisions at that point in time. It doesn't require necessarily sitting in front of the screen all day.
To add to that point, somebody might be thinking, Jack's talking about, some early experiences with Ed. I remember in the mid to late 90s being in Bill Dunn's office for the first time. No screens on the desk, and this was a screen time. No screens on the desk. There was one screen in the corner attached to an alarm, and nobody was and I don't say that to try and make it seem like they weren't paying attention. Of course they were paying attention. They just knew that you didn't have to do that to be successful.
Right, and not only it goes further than that, Mike. It's not just that you didn't have to do it; that doing it was actually an impediment to being successful.
The emotional part.
Yep.
Hey, as we kind of wind down, I want to go into a few. There's so many things I could talk about in this book. At the beginning, I said 700 pages. A couple problems that come up in the idea of a trading approach, trading systems. Two that I kind of jotted down that I thought. I like the way you broke this apart. You say, okay, one problem could be a whipsaw. What's the solution? Another problem could be the failure to exploit a major trend. So if you are having whipsaws, for example, and I'm sure there's plenty of people out there that are, what becomes that solution, the path to go down to try to solve the problem of whipsaws? And secondarily, if you're not exploiting the major move, what's going on there? Give people some perspective.
Let's take them one at a time. So whipsaws so if you're a pure straight trend follower, and that can still work, but if you do that, there's no way in the world that you can not get hurt significantly if you have predominantly whipsaw markets. One way to counter that is to add some counter trend type markets. Now, counter trend is not the opposite of trend, okay? Because then people say, well, if you're trading trend on one way, counter trend on the other way, don't they just wash each other out? Yes, if you don't do it right. But, and I'm not saying it's easy, but you can come up with certain ideas that are counter trend in nature. So, for example, like one of the ideas that I think is really critical in this book is the idea that, and I call it, I think, the most important rule about chart analysis, but it can be applied to systems as well, is that when a signal, or what should be a classical signal, fails, that failure is itself often more reliable than the original signal. So you can take an idea like that and systematize it, sort of define patterns, code patterns. You can mathematically define them. When a market does this, and you can define exactly what the failure is, and then it does this, then that becomes a signal of a reversal. So there you have, what you end up doing is you've got, let's say, a breakout, and then you have a pullback, which goes beyond a certain point where it shouldn't, and then you're going short. I'm talking about a breakout on the upside originally, and then you're going short, but you're going short not that far from the high. It may not be a good trade, or it may be a good trade, who knows? But the point is, it's more of a counter trend trade because it's really, the trend hasn't yet developed on the downside. You've just defined a pattern now that says, hey, this could have been a trap, and this may well be a reversal. So you now have a system which is going to make money when the market has just failed and it's going counter trend. Now, if, let's say, it does breaks down and goes down, then you're in that market with this system is giving you a signal where you're making money because of a whipsaw type of trade. On the other hand, you have trend systems that are making money, a non-whipsaw type of condition. So if you combine the two, you can get a total trading methodology that mitigates the damage of whipsaws. That's the example of whipsaws. Now, exploiting a trend. So here's the thing. Most people think of things as being purely dynamic. You buy one spot, you get out at the other spot. So let's say you get in and your system gets you into a long trade on a market that's goes for a long uptrend, a really long uptrend. Great trade. You make tons of money, okay? However, along the way, that market has dips and goes up again and so forth. So there's no reason why that market can't be traded again for an additional unit with an appropriately close stop. You can define a system where you get your base position on in one circumstance, but it also defines situations where you will add to that position with a stop under certain
to pyramid.
You pyramid, but not just because it's going up. So the pyramid, my example of a good pyramid would be more of like you get a trend down, and then it starts going back up, and you've defined how much of reaction down and what the signal for a trend up is, a resumption of trend is, and then you put your trade on, and then you have a close stop. So there you start adding to your position, but you're not pyramiding in a classical sense, because if that trade fails, you take a loss just in that trade that's commensurate with it being a single trade and an additional trade and not a big loss. But if you've caught the reaction right and gotten in again, then you might substantially increase your profits. So again, here's an example of how you can exploit a trend for more than just a single trade.
You know, you also, to add to the whipsaw comment, something that you mentioned in the book, quite straightforward: diversification and filtering those signals. So, you know, if you are having a major whipsaw problem, not only adding another system, but adding other markets also helps as well, right? And then two, if you're getting whipsawed too much, maybe you need to look at that original technical signal to begin with.
The diversification part, I believe in diversification in as much as you can afford it. So multiple markets, multiple systems, and, you know, if you, let's take it theoretical, ideally what you would do if you had, you know, let's say you're managing money, you have enough money to do this, but the right way to do it is multiple markets, multiple systems, and multiple parameter sets within each system. You know, so I'm not a believer of you optimize for the best parameter. As I explained in the book, I think optimization is way oversold as a viable technique. So you may define an area where the system works maybe best or might be, but you should give very little weight to that particular variation, because the optimized parameters don't have much stability. What works well in one year may not work well at all in the next year, even though the basic system may work over time. So I also believe in diversifying by parameter sets. What that means is, just for your audience, if there's getting too much terminology here, but let's use a simple example. If we had a crossover moving average, and you were trading, and you said 1050 did really well, and you want to trade that, well, that's fine, but you should maybe also trade, a 10100 or 1030, just get some variation, so it's not all the same parameter set, even though it's the same system.
Yeah, you don't want to be on some extreme peak where if you take 1 inch step in either direction, you fall off the cliff and die.
No, that's a sign of a bad system. But you can get systems that work over broader parameters, but still there could be a lot of variation from one year to the next. Which are the worst and best? I'm
just kind of throw some data points out there and let you kind of go how you see it. You do talk about the Sharpe ratio in this work as a measurement, and for those that know the Sharpe ratio, or at least a lot of people from my world will see the Sharpe ratio as having a problem because it kind of penalizes upside risk, and people have invented ratios to try and kind of mitigate that. But so many people in the investing field, they still, hey, what's your Sharpe ratio? What's your Sharpe ratio? And to me, that always seems like a blinking red light of like, hey, hold on, maybe this person's not really thought through all the issues. But to take that also with the idea of drawdown, I don't know how one achieves any success in life. I mean, just about anything requires drawdown. And, in my particular world, some of these automated trend strategies, look, extensive drawdown is like par for the course. There's very few very, very successful trend following traders that, have drawdowns of 10 or 15% a year. It just doesn't seem to work that way. And I want to add to this kind of thought process too, which is, in my world, and you've written about many of these same people, drawdown is the scarlet letter. It's really like this awful thing. But I'm looking at a great line from Warren Buffett. It says, unless you can watch your stock holding decline by 50% without becoming panic-stricken, you should not be in the stock market. Now, I know you're going to have a counter to that. But also to note, since 1980, Berkshire Hathaway has had drawdowns of minus 51, minus 49, minus 37, and minus 37. And even going back in time, back in the 70s, the 73, 74 bear market, Charlie Munger, his partnership, pre-Buffett, went down 32% in 73 and 32% in 74. I find that really interesting because I don't think most people would think of as a guy like Buffett as being that high of risk.
You're absolutely right on that. So a lot of great both fundamental and technical traders have significant drawdowns along the way. And as you said, and I agree, you can't have the gains unless you're willing to take the drawdowns, because sure, everybody wants to avoid the pain. And in fact, in many ways, trying to avoid losses is why people lose, because in many ways, I mean, that's one way is if you're unwilling to give enough room for a position to work, then you're going to get knocked out of too many good trades. Another way, of course, is if you're so worried about a loss that, if you can't take a loss, then you then do the opposite. You just keep on staying with it. Then you let a small loss turn into a major disaster. So but that's for a single trade as opposed to a drawdown of the whole portfolio. Now, have an interesting example, because people like Buffett and people who are long-term trend followers would be more like your type of approach. Those two approaches couldn't have less in common. But the interesting thing is they both require drawdowns to work. In Buffett's case, because he doesn't buy positions for 2 weeks, 2 months, 2 years even. He buys stuff for a really, really long time. Probably 2 decades is a better description than any other two, right? He's very long term. So if it's going to work to fruition, he's got to give it time, and he's not going to be. As long as the fundamentals are there, his fundamentals, his value, he's going to stay with the trade. And as a trend follower, trend following works over time because there are trends in the market, but there's also a lot of reaction to trend, and the market will be very adverse to trends for sometimes extended periods of time. If that were not the case, then that's the only reason it can still work, because trend following is easy in a way, conceptually easy. It's not hard to code. And if you could make money, good returns, without having significant drawdowns, everybody would do it. But by definition, if everybody does it, it can't work anymore. It's intrinsic that approach is going to have significant drawdowns.
And I think what's also a great place to kind of pause here for today is that both of those approaches, just as you defined and explained, it's the behavioral element. The philosophy starts with the trading philosophy, either if you're going to go down the Buffett path or the trend following path or a pattern recognition path. You've got to start with a philosophy that's sound. And I would think most sound market philosophies today are built on the idea that the efficient market theory is just really, I don't think the guys at the University of Chicago got that one exactly right.
Yeah, well, we totally agree. And in fact, I have a chapter in a book, that Market Sense and Nonsense book, where I just devote an entire chapter to debunking the efficient market hypothesis. And we could talk an hour on just that alone. So we won't get off on that tangent. But I totally agree.
It's kind of the root of the whole conversation, though, because all the strategies, the things you're talking about in this work that I'm looking at right now, this book that's so thick and so heavy I could hit someone over the head with it and hurt them. But all these things work because the efficient market theory isn't accurate.
Yeah, the efficient market, theory is the markets act like they're efficient a lot of the time, and that fools people. But there's lots of evidence that the markets act also inefficiently and have tremendous inefficiencies. And without getting into all the examples, but there is all that evidence out there.
We'll save that for our next one.
You know what? But this is too good of an example. I think your audience will appreciate it. It's not even my own. It's Richard Thaler, the behavioral economist. I don't know if you've interviewed him or not. Have you?
I've not interviewed. I just had Cass Sunstein on, so I'm going to try and get Richard next.
Okay, yeah, so he's great. And I saw him in a talk when I was living in Seattle. He gave this example, and you will just love this example, and I'm sure the audience will find it a real kick. So there's a closed-end mutual fund. Okay, closed-end mutual fund, for those people who don't know what it is, it's like a regular mutual fund, except you just the fund is held until it ultimately liquidates. It's not trading in and out like a normal mutual fund. But what happens with closed-end mutual funds is they typically will start out at value of the portfolio, maybe a bit of a premium, but over time most of them go to a discount because of that lack of liquidity. And so there was a closed-end mutual fund called Cuba, CUBA. It was like most closed-end mutual funds trading at about a 10 or 15% discount, right? Now, one day, that closed-end mutual fund goes from minus 15% to plus 70% premium to its portfolio in one day. Now, what happened in that one day? President Obama said we're going to normalize relationships with Cuba. Now, what makes this so funny is that this fund, Cuba, did not hold any Cuban stocks or any holdings in Cuba. It was just Latin America. And B, even even if it wanted to hold Cuban stocks, it couldn't because there's no such thing, and it would be illegal. The irony is this closed-end mutual fund, because of its initials, CUBA, goes from -15 to +70 in one day because Obama is normalizing relations with Cuba, where there's not a single equity that relates to that in their portfolio. So, I'd like to have an efficient market hypothesis believer explain to me exactly how the markets are efficient with that, and can have that happen. That's one extreme example.
Let me add one thing to that too, which I find really interesting about the efficient market theory hypothesis, is it's kind of political. Like I grew up kind of conservative family. I've kind of find myself, for lack of a better term, in the libertarian space these days. But I find that this efficient market theory, there's a certain partisanship around it to some degree, whereas I just look at it and I say, just on the facts and all the evidence that I've seen for 20 years, it doesn't make any bloody sense to me. There's nothing, but I find that there are some territorial, I could use a kind of a unnice word, territorial blanks surrounding it, where I just think if you kind of got an open mind and you look at it, you're like, hold on. There's no explanation inside the efficient market theory for October 2008. There's no explanation for it. It's just kind of like, oh, let's just put that one over here. Let's don't talk about that example,
Yeah, right. I mean, there's tons of examples, right? So but to give the other side some due, okay? And I divide the world into what should be two types of market participants. One are people who have some reason to believe that they have some edge and can trade and make intelligent decisions and do better than the index or whatever. And the other is people who really don't have a passion for the markets, haven't done the research, don't have the skill, whatever. Now, for the second group of people, I actually believe that believing in the efficient market hypothesis is probably the best thing they can do, because the best thing they can do with their money is just go into a low-cost mutual fund for a long period of time, and that way they get the market average and they pay the lowest cost, and that for them makes the most. And that is what an efficient market hypothesis theorist would recommend as well. So I think there is a segment that may, and even a majority of the population for whom that is acting as if the theory is correct, is the right thing to do. But what the extension of that is that no one should try to beat the market because it can't be beat. That's where you and I agree that advice is not valid.
On the passive index, one final point there, and I know you just kind of gave, I don't know if it's, you can tell me if you firmly believe that or if that's kind of more of the talking point, because I always look at something really simple when I hear that particular perspective on efficient market theory, which is the Japanese. I mean, my gosh, their highs were 40,000 in 1989, and they're at 20,000 on their equity index. That just seems like if America ever got to that point, I don't think anybody would say, if we were if we were down that far, 50% for decades, I have a feeling very few people would be saying passive indexing is good. But right now, at all-time highs, passive indexing is a strategy that many are saying is a good thing to go. But on the Japanese point, I think it is a valid point.
Yeah, no, it's a valid point. It's a valid, that is a valid point. And actually, when I was saying this, and that's buy and hold, which not quite the same as efficient market, but still, no, yes, I take your point, and it's a fair point. And I wouldn't necessarily say to somebody now, what should I do? Is put 100% of your money into a long-only stock index. But I was talking more about a lifetime. Let's say you're a younger person and a lifetime philosophy, and about sort of dollar averaging.
And you don't want to think about the markets.
Yeah. It's not your game. You don't have any special knowledge. So if you're going to just save party money and always put, so you get the dollar averaging effect work for you, and you just put it in over the next 30, 40 years into the market in a lowest cost. I would say a person like that, don't try to find the best trade in the world, and just put in a low, your lowest cost. That's probably your best shot.
I don't think those people are buying your books or my books, though. I hope
no,
not.
They're not, and they're probably not listening to this show. But right. But I guarantee you, everybody listening to this podcast knows at least 20 people who that description is appropriate for.
So, A Complete Guide to the Futures Market, second edition, technical analysis, trading systems, Fundamental analysis, options, spreads, and trading principles. Jack Schwager, Mark Etzkorn. Yeah, there's a lot in here that we did not discuss. This is one of those ones you got to put on your shelf and go slow. There's a lot of detail, but I highly recommend.
Hey, Mike, a pleasure as always. Thank you.
Hey, where can we send people? Where's the best place to go?
Oh, okay, yeah. So,
for
the book, just go, just Amazon. And you put my name in Amazon, or just, Also, I'm involved as we talked in another program with fundseeder.com, which is a startup for traders who want to get free analytics. So you mentioned the Sharpe ratio and all that, and I've got the same criticism of the Sharpe ratio. We have lots of other statistics on there, lots of other graphics. It allows traders to get their accounts directly linked to their brokers, not for all brokers, but for the ones that are linked right now. And that's fundseeder.com. Fund and cedar, like it sounds. And I've got, my own website is just my name, jackschwager.com.
Jack, I appreciate it. You still are always, if I go back and I look at my traffic stats on this podcast, early 2012, I believe. I think it was early 2012. Yeah, that was like the traffic's like, okay, it's okay. Then you appear for the first time, bump. So thank you for all those years ago bump, because I have to keep, and you've always paid nice compliments that I go for the diversity of guests, and I keep trying that. Like I said, just to Cass Sunstein, I never would have thought I would have had a Harvard law professor on talking his most recent book, but that's where this podcast is going.
Yeah, so. And I've complimented you before on it. I think you've taken this podcast in a great direction. I think it's you thought outside the box, and you took it outside of just markets, and you've had a lot of really interesting people on. I think that's a great direction you've taken it in.
Jack, I appreciate it. We'll talk again soon.
Okay, take care, Mike.
I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.